Monist view, and today we are discussing one of a weekly profitable option strategy, that is weekly calendar spread. Here we are going to describe the background, when to execute, how to execute, example, important level, advantage, disadvantage, how to make adjustment, and the conclusion. So before going through, if you want to read the article, then the article link is provided in description. So let's start. Background of the strategy. Weekly calendar spread strategy is a strategy mainly focused on consecutive 2 weeks option premium. This strategy involves two leg, buying leg and selling leg in different period of expiration. When to execute? Weekly calendar spread is a non-directional strategy which has to be deployed when the view about the market is a range bound. Here the key is to establish a support and resistance level in the market and try to take advantage of option premium decay. How to execute? Weekly calendar spread, as discussed, consists of two leg, buying leg and selling leg. When option sold in current week expiry, the option buy should be in the next week expiry. Let's take an example. Let's see Nifty is currently trading at the level of 16,000 in the first week of January 2021. Then the first we will draw a support and resistance level. Let's say the support we find 15,800 and resistance we find at 16,200. 200 points away from both sides. In this case, we will sell one put option of a 15,750 and one call option of a 16,250 for the first week of a January 2021, and buy one put option of a FAR OTM call and put option. Let's say put option of a 14,001 and call option of a 17,000 we have bought of the second week of a Jan 2021. Now let's discuss the important levels. What is the net inflow here? The net inflow is the amount of a net premium we receive from selling the options of a first week and buying the options of a next week. In this strategy, our lower break even would be the strike of a put sold less net premium received, and as far as upper break even is concerned, upper break even will be strike of a call sold less net premium received. Maximum profit here we can earn is the amount of premium which we receive, and maximum loss will be strike of a call and put sold less the net premium option received. The margin required, since you know that the SEBI has been dynamic about the margin, but since this strategy is a completely one-to-one hedge supported by the buying of an option for the next week, the margin requirement is up to a 50,000 without a leverage. And the last important point, what is the risk reward ratio in this? Risk reward ratio is 1:0.05. Now let's discuss what are the advantages over here. Number 1, weekly calendar spread strategy is a fully hedged strategy with a limited profit and limited loss. Second, this strategy has a less margin requirement. As we discussed, without leverage it's a 50,000. Third, this strategy is give you a good theta decay because we are taking this strategy in overnight, and that is the fourth advantage also. If you want to achieve the theta decay, only two options are available, either overnight or go with the direction. So here we are choosing the overnight position. Fifth advantage is this strategy can handle a little Vega movement as well. If you are trading in intraday, a little Vega movement will influence your profits. Number 6 advantage is this strategy is very easy to apply and execute. Number 7, weekly calendar strategy has a very easy adjustment which we will discuss further, and this strategy is the best when the market is a sideways. Let's discuss the different disadvantages. Number 1, this weekly calendar spread strategy, sometimes the second week the option premium we get are not that good and the question of liquidity will arise. But since we are dealing with the index, it can be performed, but as far as stocks are concerned, it is not available as they are not available for the weekly expiry. Second disadvantage is any wide delta move can create a subsequent losses. The third major problem over here is a fundamental thing compared with a technical thing, and that is view can go wrong. If our view is sideways but the market is not actually sideways, then we will be in a trouble. The major disadvantage over here is possibility of support and resistance can be a vital. If we get wrong in the finding support and resistance, then our losses can be huge. Also, since we are deploying the strategy for overnight, we carry an overnight risk and subject to a black swan event. Also, any directional move can cause losses in this strategy. Let's discuss the most important point over here is how to adjust this strategy. Suppose if we have deployed the strategy for sideways market but there is a huge move up, then what will we do? For down move, we will sell additional call in the first week and buy break even put in the first week. Similarly, it happens vice versa. For up move, we will sell additional put in the first week and buy break even call option in the first week, so that we will receive an additional premium by selling the call and put respectively of other side, and hedge our position through buying our losses in the same direction. So what is the bottom line over here? Weekly calendar spread strategy used in a non-directional market. Weekly calendar strategy is an overnight theta decay strategy and is it easy to deploy and very simple to use. If you want to read the full strategy, then we mention the article link in the description. You can read this strategy full in our article. Thank you for joining with us.